There is a moment right before someone signs a commercial lease for the first time when they pause. The pen is in their hand. The landlord is across the table. The numbers on the page are larger than anything they've committed to before. And in that pause, if you knew what to look for, you could predict with reasonable accuracy whether this person will build something that outlasts them, or whether they will spend the next 30 years chasing a better investment that never quite arrives. The Rockefeller family office signed its first commercial lease in Cleveland in 1863. Not a land purchase. A lease. John D. Rockefeller was 24 years old, working as a produce merchant, and he needed warehouse space near the rail lines. He didn't own the building, he paid a landlord monthly to use it. Within 4 years, he had signed 4 more. By the time Standard Oil was incorporated in 1870, the family had a functioning understanding of commercial real estate that most people spend a lifetime missing. That owning property is one business, but controlling it on paper through a lease is a different business entirely, and the second one scales faster, carries less downside, and almost nobody talks about it. What you're about to hear is not about flipping houses. It's not about short-term rentals or real estate investment trusts or anything a financial influencer has recommended in the last decade. It's about a specific category of commercial property, the kind that looks unglamorous, that doesn't photograph well, that generates no headlines. And the reason old money families have quietly held it across 4 and 5 generations while everyone around them argued about whether to buy tech stocks or gold. The category is this: single-tenant net lease commercial property, a term most people have never heard. A structure that produced compounding returns through the Great Depression, through the stagflation of the 1970s, through 2008, through the COVID shutdowns, not because it's magic, but because of what it is mechanically. Here's how it works. A business, a pharmacy, a fast food chain, a dialysis clinic, a dollar store, a gas station, needs a physical location. It does not want to own the building. Owning the building ties up capital that the business would rather deploy into inventory, operations, and expansion. So instead, the business leases the property from an owner. The lease is long, 10 years, 15 years, sometimes 25. And in a net lease structure, the tenant pays not just rent, but also the property taxes, the insurance, and the building's maintenance costs. The landlord receives a check every month. The landlord does not fix the roof. The landlord does not call a plumber. The landlord does not manage a property manager. The tenant handles all of it, because under the terms of the lease, the building is effectively their operational responsibility. The landlord's obligation, at its most stripped down, is to have purchased the building correctly in the first place. That's it. Buy well, hold, collect. The income stream this produces is sometimes called passive income, but that phrase is used so loosely it has lost most of its meaning. What this actually is, in legal and financial terms, is something closer to a bond. The tenant has signed a contract promising to pay a fixed monthly amount for a fixed number of years. If the tenant is a publicly traded corporation, and the tenants in most institutional-grade net lease deals are exactly that, companies like Dollar General, CVS, Walgreens, McDonald's, Taco Bell, FedEx, then the income stream is backed by a company with revenues in the billions and a legal obligation to perform under the lease. If they don't pay, they are in breach. The landlord can sue. The landlord usually wins. The tenant knows this, so the tenant pays. This is why the Mellon family, as documented in estate records that became public after Richard King Mellon's death in 1970, held a significant portion of its real estate exposure not in residential property and not in office towers, but in exactly this category: long-term leased commercial properties tenanted by businesses that had no plausible reason to close. A gas station on a highway corridor, a pharmacy anchor in a small town, a distribution facility outside a mid-sized city. Nothing that showed up in the society pages, nothing that got written up in the financial press. Just a check every month for 15 years, with a tenant paying the taxes and the utilities and the maintenance. The question people ask when they first hear this is, why doesn't everyone do it? The answer splits into 2 parts, and both of them matter. The first is scale. For most of the 20th century, the entry point for single-tenant net lease property was high. A Walgreens tenanted building in a secondary market might sell for $2 million. A McDonald's ground lease in a suburban corridor, $1.5 million. A Dollar General in a rural county, closer to $800,000, but with different risk characteristics. These were not numbers accessible to the average investor. They were accessible to families that had already accumulated capital, which meant the strategy stayed inside the circles where it originated. You needed either the capital to buy directly or the connections to join a private syndication, and private syndications didn't advertise in newspapers. The second reason is that it is, from the outside, profoundly unexciting. There is nothing to discuss at a dinner party. You cannot watch it appreciate in real time. There is no ticker symbol, no volatility, no moment of drama. For the average investor conditioned by decades of financial media to associate activity with progress, a net lease property feels passive to the point of inertia. The check comes. You deposit it. Nothing happens. That is, for many people, psychologically unsatisfying in a way that turns out to be financially catastrophic, because the itch to do something with the money, to find a better opportunity, to rebalance into something more interesting, is where most of the returns get lost. Old money doesn't have that itch. Or more precisely, it trains the itch out. The institutional knowledge that passes through family offices is not about finding the next opportunity. It's about not abandoning the current one. There is a letter in the Rockefeller Archive, referenced in Ron Chernow biography, in which John D. Rockefeller writes to his son with a line that estate attorneys have quoted ever since. The secret to wealth is not the rate of return, it's the length of time you leave it alone. He was talking about Standard Oil stock at the time, but the principle applies with specific precision to net lease real estate. A Dollar General store opened in a small Midwestern county in 2002. The building was purchased by a private investor for $650,000. The lease was 15 years with options to renew. The tenant paid taxes, insurance, and maintenance. The investor collected approximately $52,000 a year in rent, a return of just over 8% on the original purchase price. 15 years later, in 2017, the tenant exercised its renewal option. The rent stepped up slightly, as specified in the original lease. The investor's annual income rose. The building's market value, because the lease had been renewed and the income stream confirmed, increased to approximately $900,000. The investor had been paid roughly $780,000 in rent over those 15 years, had incurred minimal management costs, and now held an asset worth $250,000 more than the purchase price. Total return over 15 years, without leverage, above 130%. Annual equivalent, just under 6%. Not spectacular. Completely reliable. Entirely uninteresting to anyone watching financial television. Multiply that by 4 properties, by 8. Hold them across a generation. Pass them to children who were raised to understand that the check is not a windfall, but a system, and that the system works because you don't interrupt it. That is what $2 million in boring commercial real estate looks like when it's handled correctly. The leverage question deserves attention here, because it changes the math significantly. When families with sophisticated advisors purchase net lease property, they typically don't pay cash. They use commercial real estate loans, sometimes called CMBS loans, sometimes structured through local banks, and they borrow 60 to 65% of the purchase price. On a $1 million property, they put in $350,000 to $400,000 of their own capital. The tenant's rent covers the mortgage payment, the property taxes, the insurance. The cash flow above the debt service goes to the owner. The owner's return is calculated not on the full purchase price, but on the equity invested. If the property yields 6.5% on total value, and the debt costs 4.5%, the equity return is substantially higher. Though our tenant is, in effect, paying down the mortgage for you, over 15 years the loan balance shrinks. The equity grows, the income stream continues. This is not a new insight. It is the mechanical basis of nearly every private real estate fortune assembled in the United States in the 20th century. What varies is the type of property. The principle doesn't vary. The question of which tenants matter and why is where the practical detail lives. Not all net lease tenants are equal. The structure protects the landlord from operational involvement, but it does not protect against tenant failure. If the tenant closes, the income stops. The property may sit vacant for a year or two while a replacement is found. This is the primary risk in single-tenant net lease, and it is also the primary reason that sophisticated buyers focus on tenant credit and lease term above all other variables. The strongest tenants in this asset class, the ones that old money has consistently favored based on documentation of family office holdings from the 1980s onward, share specific characteristics. They are in businesses that do not close when the economy contracts. Pharmacies do not close in recessions. Dollar stores grow in recessions. Their customer base expands when disposable income compresses. Dallas's clinics run at near constant utilization regardless of the economic cycle, because the patients who need dialysis 3 times a week are not making discretionary decisions. Gas stations at highway intersections move fuel regardless of whether the stock market is up or down. The phrase used in institutional real estate circles for these businesses is recession resistant. The phrase used by estate attorneys who have watched families hold these properties across multiple downturns is simply reliable. Same concept, different emphasis. A family that identified this pattern in the 1970s bought a pharmacy-tenanted property in 1974, held it through the recession of 1981, through Black Monday in 1987, through the S&L crisis in the early 1990s, through the dot-com collapse, through 2008, and passed it to the next generation, would have experienced one continuous income stream across 50 years, interrupted only if the specific tenant closed. Most of the tenants in that category didn't close. They expanded. There's a historical irony here worth naming. The families most associated with excess and spectacle, the ones whose names appear on museum wings and university buildings, did not build their wealth through spectacular investments. They built it through boring ones, held without interruption, managed with an almost pathological lack of excitement. The spectacle came later, after the capital was large enough that even the interest on the interest was more than most people earned in a year. The foundation was never exciting. It was a check every month from a tenant who had signed a contract and had a legal obligation to honor it. What changed in the last 15 years is that the entry point dropped. Real estate investment trusts focused on net lease properties. Companies like Realty Income, National Retail Properties, Store Capital before its acquisition, made it possible to buy fractional exposure to portfolios of exactly this kind of property for the price of a single stock share. The mechanics are not identical to direct ownership. The tax treatment differs. The control is absent. But the underlying income stream is the same. Long-term leases, credit-worthy tenants, recession-resistant businesses, monthly distributions. Realty Income, to use the most documented example, has paid a monthly dividend without interruption since 1994. Through 2 recessions, a global pandemic that shut down retail, and multiple cycles of rising interest rates, the company calls itself the Monthly Dividend Company and has done so for 30 years. That's not a marketing tagline. It's a description of a mechanical function that has not failed in 3 decades because the underlying leases are structured to continue paying regardless of what happens to consumer sentiment or equity markets. The people who held Realty Income stock from 1994 through 2024 and reinvested every dividend did not beat the S&P 500 in most individual years. They also did not need to. The compounding effect of an uninterrupted monthly income stream, reinvested without emotional interference, produced returns that compare favorably to every alternative most retail investors actually achieved, as opposed to the alternative they were theoretically chasing but practically abandoning at the wrong moments. Old money has known since the 1860s what most retail investors are only beginning to understand now. The return that matters is not the highest available one. It's the one you can hold long enough to let compounding do the work. The boring $2 million property that throws off $130,000 a year, year after year with a tenant legally obligated to pay, is worth more in practice than the exciting $2 million position in something that requires constant attention and generates anxiety as a byproduct. The Rockefeller who paused before signing that first lease in 1863 was not thinking about any of this in these terms. He was thinking about where to store produce near the rail lines, but the habit formed in that decision. Use the asset without owning it when ownership serves no purpose. Own it when the income stream justifies it, and hold it long enough to matter. Outlasted Standard Oil. Outlasted the breakup. Outlasted 3 generations of heirs who could have spent everything down to zero and didn't. The building is still the simplest version of the lesson. Find a tenant who needs a location. Make sure they need it badly enough to sign a long contract. Make sure they're large enough that they'll still be operating in 15 years. Collect the rent. Don't touch anything else. That's the whole thing. That's what $2 million handled correctly looks like when it outlasts the people who assembled it.